Hi folks, welcome back to Murthy Finance Academy. Let us start. Today we're digging into the latest Q3 earnings from India's affordable housing finance sector. Now, if you just look at the headlines, everything seems pretty solid. But once you scratch beneath the surface, you start to see some really interesting and kind of conflicting signals. It looks like we're at a key turning point for the industry, so let's break down what's really going on. So this really gets to the heart of it, doesn't it? Is the big post-pandemic boom in affordable housing finance finally starting to lose steam? The truth is, the data from this quarter is pointing in a couple of different directions at once, and figuring out how to read these mixed signals is going to be crucial to understanding where the sector is headed next.
And this is the core puzzle we need to solve. On one hand, you listen to the earnings calls and you hear management teams talking about how demand is still super strong. But then, on the other hand, you actually dig into the financial statements and you can start to see these little cracks appearing, some early signs of stress. This gap between the story and the numbers, that's the most important theme this quarter.
In this slide just lays out that contradiction perfectly. On the left, you've got the official company line. The market is robust. But on the right, you see what a sharp analyst is pointing to in the data, a sharp rise in gross Stage 3 loans. Now, that's just a fancy way of saying more loans are going bad. And the wildest part? Both of these points were brought up on the exact same earnings call. That tells you right away the real story is way more complicated than the headlines.
So what happens when the narrative and the data start to pull in opposite directions? Well, it forces companies to make a choice. And right now, we're seeing the industry arrive at a fork in the road. Different companies are starting to take very different paths. Some are doubling down on growth, while others are starting to pump the brakes and focus more on managing their risk.
Okay, so let's first look at the companies that are basically still full steam ahead, keeping their foot on the accelerator and prioritizing that aggressive top-line growth.
And you can see that strategy right here in the numbers. I mean, look at this. One of the big players grew their assets under management, their AUM, by almost 25% year over year. Another, Aptus, is right behind at 21%. Now, on the surface, those are impressive numbers that seem to back up that whole robust market story. But, and this is a big but, that's only half the picture.
Because at the very same time, you have other really important players who are making a very conscious decision to ease off the gas and deliberately slow things down.
I mean, you don't even have to read between the lines here. This is a direct quote from India Shelter's management. They're openly saying their growth is softer because they need to monitor the situation on the ground. In the world of finance, that's basically code for, we're seeing some potential problems with credit quality and we're choosing to be cautious. So what exactly are they seeing?
This chart right here, this is the situation on the ground they're talking about. Their gross Stage 3 loans have ticked up from 1.2% to 1.5% in just a year. Now, that might not sound like a huge number, but in the lending business, it's the direction and the speed of the change that matter. This kind of trend is a classic early warning sign. And just so we're all on the same page here, when we say gross Stage 3 or GS3 loans, we're talking about loans that are seriously late. The payments are overdue by 90 days or more. It's really the main way analysts check the health of a lender's loan book. So a rising GS3 number means more and more borrowers are struggling to pay. You know, it's not always just about the hard numbers. Sometimes the language that management uses gives you an even clearer signal. The change in tone from one quarter to the next can often tell you where their strategy is heading before the numbers even show it. And the difference in tone this quarter is, well, it's night and day. On one side, you've got this very confident, bullish language, strong momentum, robust profitability. And on the other, you hear this much more cautious, almost defensive language about monitoring the situation. This tells you they have very different reads on what's actually happening with their customers. But what's really interesting is that across all the calls, from the aggressive growers and the cautious players, a few common worries kept popping up. First, everyone is suddenly obsessed with lowering their cost of funds, meaning how much they pay to borrow money. Second, they're all talking about rising competition and customers jumping ship to other lenders for a better deal. And third, you're hearing this subtle shift in focus from just getting new customers to managing the risk of the ones they already have. Okay, so let's connect the dots here. You've got some companies growing fast, others slowing down. You've got pockets of rising stress in the loan books, and you have management teams all starting to talk about the same pressures. When you put it all together, the real insight becomes pretty clear. This isn't just about one or two companies having a good or bad quarter. This is a signal that the entire industry cycle is starting to turn. It really boils down to this. The rules of the game are changing. For the last few years, the big question was always, how fast can you grow your loan book? That was the main measure of success. But now, the question is shifting to how well can you grow? The market is starting to care a lot more about the quality and the sustainability of that growth, not just the raw speed.
What we're seeing play out is a textbook credit cycle. We've moved past that early, easy phase where a rising tide lifted all boats and everyone was growing like crazy. We are now firmly in the mid-cycle, and this phase is always defined by a few key things. Overall growth starts to slow down, competition gets way more intense, and most importantly, credit quality becomes the single biggest thing that separates the winners from the losers.
So given everything we've talked about, what should you be watching over the next few quarters to track how this all plays out? We put together a quick dashboard of the key things to keep an eye on.
At the big picture, industry level, there are four main things. First, the pricing environment. Are companies starting to cut rates to win business? Second, cost of funds. Is their own borrowing getting cheaper or more expensive? Third, and this is a big one, watch those delinquency trends. Does the stress we saw at India's shelter start popping up everywhere else? And finally, keep an eye on expansion. Are companies still opening new branches like crazy, or are they pulling back? And then, when you're looking at any single company, here's a quick checklist. First, just listen to the tone of management. Are they confident or cautious? Second, watch their margins. Is the gap between what they earn and what they pay for money getting smaller? Third, compare their growth rate to their asset quality. Are they growing fast but taking on a lot more risk to do it? And finally, look for any changes to their future guidance. Are they quietly lowering expectations for the year ahead?
So the bottom line is this. The easy money phase, that period of incredible growth for the entire affordable housing finance sector, is now behind us. This next phase of the cycle is going to be a real test of who has the best strategy, the best risk management, and the best execution. And that leaves us with the one critical question for the next year: who in this space has actually built a business that's designed to last through the good times and the bad?